Hi, this is Jim Denholm, founder and CEO of Ironbridge Private Wealth. Welcome to the Strategic Growth video podcast. This series is called The Big Five, where each month we'll talk about 5 themes that affect your wealth and your investments. So let's get started. In today's episode, being recorded on October 21st of 21, we're going to talk about small caps. We think this could be the key to the market going forward. And could signal what the market's going to do over the next 6 to 12 months. We'll take a look at the stock bond ratio, talk about bottlenecks at various ports in the U.S. and abroad, how that affects inflation, and look at a phenomenon called shrinkflation. And then 20 years ago, around this period of time, Enron was in the process of going bankrupt, and we'll talk about some of the effects of that. So let's get started with small caps. We're going to look at the Russell 2000 index. This shows the price of the Russell 2000 with the green is 50-day moving average, blue the 200-day moving average, and the bottom shows the price of the Russell 2000 relative to its 200-day moving average. What we've seen, this was a chart that goes back just over a year, so we had some volatility last fall. We had the presidential election, which feels like it was 10 years ago. That happened right here. And post the election, stocks just skyrocketed through early February. Starting in February, we saw this fairly unusual pattern. It's not unusual for stocks to chop sideways. It's fairly unusual for it to chop sideways for 8 to 9 months. And for it to be in a very tight range. This hasn't been, and it's kind of like a merry-go-round. It's these horses are going up and down a very small amount and ultimately going nowhere. So first back over here, when in earlier this year, the market was very stretched. It was over 30% or almost 30% above the 200-day moving average, which is pretty extreme. That doesn't happen very often. When that does happen, you would expect either the price to move back and correct in price, where we see a 10, 20, 30% decline to get this a little bit more in balance. Or we talk about this quite a bit. Markets can experience a correction in time. And that's where they simply move sideways throughout this blue box here and move sideways until things can get back in balance and catch up. Now, the direction of this breakout is what's going to be key. If the small caps break higher, that is a risk-on signal for the market. The bigger this base, typically the stronger the move. So a break higher out of this range could be very bullish for stocks in general, particularly for the Russell 2000, but probably for stocks across the market. Vice versa, if we were to see this break down, that could be a very big warning signal after this long period of consolidation that we're going to go through a deeper price correction. But it's looking to us like the upside might be a little bit higher probability. Why do we say that? Let's look to our second theme, which is the stock bond ratio. We talked about this in our last video, but what this first chart shows on the left is the ratio of stocks versus bonds. It's calculated by taking the share price of SPY divided by the share price of TLT. SPY is the S&P 500 index. TLT is a long-term treasury bond index. This chart looks almost identical to small caps. It's a little strange that something like this ratio would resemble so closely the Russell 2000 chart. So we've got the Russell 2000 again, and then the stock bond ratio. Again, they look almost identical. It goes into this theme that the Fed is flooding the market with liquidity. Different areas of the market that would normally be completely uncorrelated are not only correlated, but are extremely correlated, where they're moving almost identically. That's what seems to be happening here with the stock versus bond ratio. One thing we'll notice, it went through a very much a sideways correction for 7-8 months. It recently has broken higher. That's a good sign that there is a risk on environment currently taking place and could be about to take place even further. This is not necessarily a recent phenomenon. This is a chart that goes back to 2012. And we can see, at first we thought, okay, maybe this is something that has to do with COVID, the trillions of liquidity that was flooded. We looked a little bit further out, and this stock bond ratio in blue and the Russell 2000 in orange has had almost identical correlation all the way back to 2012. So this is not a recent phenomenon. This is definitely a phenomenon that seems to be happening in the age of the Federal Reserve being drunken sailors printing money. But if this correlation continues, stock bond ratio has broken higher, we should expect that to be the more likely case with small caps, which would be favorable for the overall market for 6 months to 12 months, possibly longer. Shifting gears here, some of the risks that we're saying, really does have to do with bottlenecks and inflation. Inflation and interest rates are some of the biggest risks that markets will face over the coming decade. And we're seeing sort of some of the reason why. There are massive bottlenecks across the globe. This chart, courtesy of Bloomberg, shows the number of ships that are off the coast of LA and Long Beach, and it's nearly 70 ships waiting to dock and unload various products from across the globe, most of them from China. So this is causing problems. It's causing some supply shortages across the U.S., and it's a range of goods that are included here. And it's really not just the U.S. that are experiencing these problems. This first chart looks at the number of days that a ship remains at a port across the globe. Now, Los Angeles is the worst. It is the least efficient. But Shanghai, for example, 4.5 days, where LA takes about 6.5 days once a ship gets to port for those goods to get unloaded on average. So about a week. Shanghai, 4.5 days. Singapore, 3 days. Houston, almost 4 days. New York, Hamburg, various ports across Asia. This is not a U.S. phenomenon. It is happening across the globe. And that is causing some prices to go up. Specifically, when a company has to, if they create a product in China, for example, and they want to sell that into the U.S., part of the cost of production is the transport. And freight rates, which is the chart on the right, have almost quadrupled since COVID started. And that's not just a LA issue. The cost to go basically from Asia to North America have almost quadrupled. That gets passed along to either the companies eat the cost, which happened at first. Now they're starting to try to pass that along to consumers. And we're starting to see various indications of the inflation indexes start to go up, and we can start to see it in goods that we're purchasing here. So when we look at these different port issues, it does have a direct impact on inflation. So let's look at inflation. This chart looks at both headline inflation and core inflation. Core inflation excludes food and energy prices. I don't know who is living in a world where they don't need food and energy. It's one of the criticisms of those, but either way, you can see there's a very high correlation between the two. We're starting to talk about how there's an inflationary environment right now, but frankly, we're just getting to the areas, this roughly 3% inflation rate, that the hyperinflationary environment in the US started in the late 60s. So from the late 60s to the early 80s, this is when we saw hyperinflation. We saw the interest rates go up. I was not in the investment world, but we have friends and clients who can remember buying a house at 13 or 14% interest rates. We're now at inflation levels that were at the very start of the inflationary environment of the 70s. So this likely has a long ways to go. This also shows that one of the themes that we've been talking about over the last 6 or 7 months is this idea of inflation waves. And we can see that in the 70s. So here from the late 60s, we saw a move from 3% up to 6% inflation, a move back down to 3%. This is what the Fed is talking about being transitory. However, it doesn't become transitory because it's just the first wave. The second wave, inflation went from 3% up to 12%. Then we saw 12 back down to 6 and 6 back up to nearly 15% annual inflation. That causes problems economically. It has effects for PE ratios. It has effects on the stock market. It has major effects on the bond market. And this is the biggest risk going forward, is that we do see some kind of rising inflation that probably is going to happen in these very similar type of waves. But it's not just a rising price that inflation can show up. We went through and looked at just a handful of consumer goods. Oreos, and these are the same priced Oreos, went from a few years ago being 16.6 ounces. The same price today gets you 15.35 ounces. So it's not necessarily going and spending more money at the grocery store and having a higher grocery bill. It is spending the same amount and coming home with substantially less. So it's shrinkflation. It's where you get less for the same amount. It's happening in shampoo. It's happening in toilet paper. It's happening in Pringles. The size of Pringles are declining. The amount of beer in a can. This was in Europe, where it's not just a 12-ounce can, but the amount of beer is being reduced. Even dogs. I can understand cats getting less, but dogs, come on. Dog treats, the same size dog or the same price dog treat is going for much less. So shrinkflation is a real thing. It's something to keep your eye out anecdotally, because that's a way that we see kind of hidden inflation, is getting less for the same price. Last theme is an interesting one that there's some takeaways from, but 20 years ago, Enron was in the process of collapsing. A couple interesting things to show here. One, we believe at Ironbridge that price is king. We don't want to rely on a Goldman Sachs or Morgan Stanley or Wells Fargo for their people to be able to think they're smarter than the market. This is an extreme example of this, but the red line is the price of Enron stock. The blue is the earnings per share. And if you notice that last few squiggles higher on the very far right of the chart, earnings per share increased each quarter for a year prior to Enron declaring bankruptcy. Repeat, earnings per share were increasing each year up to the very quarter in which they declared bankruptcy. The stock price was not. The stock price was plummeting. The stock price was telling us that something was off. Listening to price is this far better, smarter, more intelligent way to approach risk management than looking at earnings per share or predictions. Speaking of predictions, the last slide that we have, we'll pick on Goldman Sachs. They weren't the only ones. that we're doing this, but this is a research report in October of 2001 that was put out about 6 weeks before the company declared bankruptcy. It was about 8 months into a massively declining stock price, where they reiterated that Enron is on their recommended list. The conviction is high they have a high conviction for high and sustained growth prospects, even though they cut their earnings per share target for the following year. Let's make sure that we recognize that price is king, and price is much smarter than Goldman Sachs, and that's one of the many reasons that us at Ironbridge very much prefer to let price dictate actions and not be reliant on these kind of human predictions that can be completely flawed and miss a lot. But it was late November, early December that Enron actually declared bankruptcy, but we're approaching the 20-year anniversary. So that is our strategic growth video podcast for this month. Feel free to, we welcome your feedback. Feel free to visit it online, ironbridge360.com. You can email me directly, jim.denholm@ironbridge360.com. Follow me on Twitter at denholm_Jim. And then we also have a YouTube channel that this will be posted on, and it will be posted on our website and emailed out to clients as well. And we thank you for listening, and we will be back next month. Invest wisely.